Hello, and a very warm welcome to everyone who has joined our webinar today, discussing the UK economy post-COVID 1 year on. We hope you're all well and safe. Last summer, we examined the immediate impact of COVID-19 on the UK economy and specific sectors. Today, we'll provide an update on those key points, as well as share new developments that have come to fruition. After more than a year of on and off lockdowns, we no longer have to sit in cold, wet beer gardens, shivering as we eat our lunches. Restrictions have eased across England, Scotland, and Wales, with Northern Ireland expected to announce similar easing tomorrow. However, caution is the word of the week, as the Indian variant has officially been upgraded to a variant of concern. Despite a contraction of almost 10% in 2020, the biggest drop in 300 years, analysts expect a bounce back in 2021, with growth of 7.25%. To help us analyze the year ahead, we have an excellent panel of speakers who will offer their expectations for 2021. Sharing their insights today, I'm pleased to welcome Hank Potts, Director of Investment Strategy at Barclays Private Bank, Arif Ahmed, Partner at PwC, and Piyusha Bose, Counsel at Freshfields Barkhouse Derringer. As ever, before we begin the session, I'd like to remind our viewers that they have automatically been placed on mute. If you have any comments or questions, please do type these into your control panel, and we'll pick these up later in the discussion. We will also share a recording with our participants after the webinar. Thank you very much, and I'll now like to introduce our first speaker. Hank Potts is the Director of Investment Strategy at Barclays Private Bank and has been with Barclays for over 23 years. In 2018, he was appointed Director, Market Strategist EMEA for Barclays, where he works as part of a team formulating and communicating investment strategy to internal and external clients. In his current role, Hank analyzes a wide variety of asset classes, including equities, currencies, and commodities, as well as ascertaining and explaining the effects of macroeconomic changes on financial markets. Based in London, he works in the UK and across a wide range of other jurisdictions, where he interacts with private banking and intermediary clients. Hank, thank you for joining us, and we look forward to your remarks.
Well, good morning, everyone. It's a pleasure to be with you. I've been around about 10 or 15 minutes or so today, so I thought I'd use the time to briefly reflect on the impact that COVID's had on the global economy since we last spoke, consider the long-term consequences of the fiscal response, give some of our key economic forecasts, perhaps for the rest of the year, consider how much of a threat inflation is. That's certainly a topic that's been grabbing the headlines and moving the markets over the course of the past few weeks. Then finish off, of course, with our thoughts around the outlook for the UK economy. No surprise, the coronavirus, as we said before, has had the most profound impact on society and the global economy since World War II. The locking down of economies, as we know, has resulted in this record drop in activity, surging unemployment, permanent losses in output, and temporarily slower potential growth. If you look at the OECD estimates, they say the damage to the world's major economies has been 4 times greater than during the course of the 2009 financial crisis. Since we spoke, of course, the controlled lifting of restrictions did help to alleviate some of the economic pressure. A number of economies registering robust rebounding activity during the course of the summer. However, surges in infections triggering further restrictions, certainly weighing on growth at the end of last year and at the start of this year. So to finish off with that headline figure, we know it's a miserable year for the global economy. In fact, it contracted by 3.3%. To put that in some sort of context, that's the deepest contraction that we've seen since the Great Depression. We know the fiscal response has been key, but does come with some long-term consequences. The scale of the hit to the economic recovery, as we know, encouraged central banks to slash interest rates to new historic lows, inject unprecedented amounts of liquidity into the financial system. Governments have embarked upon this extraordinary fiscal response, such as allowing companies to furlough staff, as well as pledging vast sums in loans, grants, and credit guarantees. The true impact of the crisis has developed, so as governments' willingness to ramp up the measures to deal with the damage. The International Monetary Fund recently estimated that governments have now committed to $16 trillion worth of support. Governments have found, I think, innovative fiscal solutions, but as we've been talking about, they have come at a price. If you look at expectations around sovereign debt, well, we think in advanced economies, it'll rise something like 20 percentage points to 125% of GDP. In emerging markets, we think it will rise by around about 10 percentage points to 65% of GDP by the time that we finish this year. I think if public finances are to be put back onto a sustainable path, that eventually will need to happen. It's not something we expect to really take place over the course of the next year or two, but eventually that will need to be the case. There will be some longer term constraints on fiscal policy. What does that mean? It means higher taxes and lower government spending in the future. But as we've been seeing, in the short term, policymakers have been gambling that doubling down today on that fiscal response will boost the trajectory of the recovery, thus making it easier to repay some of those outstanding markers. In terms of our key forecast for the global economy this year, I think the vaccine is obviously key. We think it will create herd immunity by the time that we get through the second quarter in the UK and also in the United States, thus allowing growth to accelerate. We think Europe is inching towards that herd immunity status, but probably won't get there until the end of the third quarter. In terms of policy, overwhelming monetary policy support we think will be maintained to ensure the recovery and the sustainability of debt. But emergency fiscal measures, things like the furlough programs, we think will eventually taper off during the course of this year. In terms of the growth profile for the global economy, I think advanced economies will underperform emerging markets, the likes of China and India bounce back. Now, clearly the second wave is having a devastating effect on India once again, and we have reduced our growth profile for India, but we still think it will grow at a very respectable 10% year on year. China, we've got at 9.4%. We know that manufacturing has very much been leading the recovery over the course of the past few months, and we think that will be the case through the first half of the year. But if we move into the second half of the year, we think the recovery starts to broaden out, services start to add to that recovery as economies reopen. Inflationary pressures, as we know, have been building, but we think they're temporary in nature, and medium-term forecasts still remain below central banks' mandated levels. And actually, in most regions, we expect unemployment rates will still be significantly above pre-pandemic levels at the end of this year. So in terms of those headline figures around the global economy, we expect global growth around 6.5% during the course of this year, followed by growth of 4.6% as we look through 2022. As I said at the start, investors have become increasingly concerned, I think, around the threat of inflation. There's a number of key questions here. Number one, are inflationary pressures persistent? Number two, will they result in an early lift-off in terms of policy? And number three, should investors adjust their portfolios, try and mitigate some of those risks? Economists have been hiking their inflation forecast. What's been driving that? Well, the relaxation of restrictions is anticipated to lead to the unleashing of pent-up demand. Price pressures are coming from ultra-accommodative monetary policy, and of course that flood of fiscal support. Technical and statistical factors, along with surging commodity prices, are also of course having an impact in terms of what we're seeing for price pressures. I think given the broad range of both demand pull and cost push inflationary pressures, perhaps no surprise that year-on-year inflationary prints could significantly rise during the course of this year. So for the UK, for Europe, and also the United States, inflation is projected to be 1 percentage point higher than we saw during the course of 2020. However, a number of factors to us suggest that inflationary pressure is transitory. Unemployment rates are elevated compared to where we were before the pandemic. Therefore, wage growth that's often associated with core inflationary pressures is not being seen. The rapid digitalization, the ongoing investment in technology, we think is also expected to keep wage growth muted, even when labour markets start to recover. Perhaps most importantly, if you look at the level of spare capacity in many economies, still remains incredibly high compared to the start of the recession. And for us, I think that will help to anchor some of those inflationary pressures. So is tighter monetary policy on the horizon? I think given that medium-term inflation forecasts remain below central banks' mandated levels, the impact of stronger inflationary pressures on monetary policy is actually likely to be more muted than recent movements in bond markets have been suggesting. We forecast the Bank of England, the Federal Reserve, the European Central Bank will keep rates on hold not only during the course of this year, but also through the course of 2022. We do think investors need to be aware of inflationary risk, though, in order to preserve the long-term purchasing power of wealth. Investors do need to generate a return that's equal to, of course, preferably higher than inflation. And therefore, I think for investors seeking protection, there are a wide range of options they can use to mitigate those inflation risks using the likes of equities, fixed income, and indeed precious metals as well. So certainly a topic that's been really important for many of our clients, and I thought I'd share our thoughts with that with you. Finishing off a little bit in terms of the UK economy. Well, we know the outlook for the UK economy has certainly been improving. The successful vaccination program, the reopening of the economy, robust household consumption, and a lower projected peak level of unemployment all suggest that the bounce back will be strong in terms of the UK. You can argue this, it still remains debatable, but certainly there's a thought process that Brexit disruptions have been dissipating. Remember, the March budget delivered a much bigger fiscal stimulus package than was expected. And we also think the UK economy will benefit from the spillover effects of the US fiscal stimulus packages that are making their way through Congress as we speak. So in terms of the outlook, consumer strength will be incredibly important. We think the consumer will be supportive of economic growth as the economy reopens. Pent-up demand should unleash some at £200 billion worth of excess savings built up during the course of the pandemic. As I mentioned before, we are expecting a lower peak in terms of unemployment. First quarter labour market figures, as we saw yesterday, were positive. The unemployment rate actually ticked down to 4.8%. Payrolls, perhaps more importantly, are rising for the first time since the pandemic started. Although we should recognise there's still 772,000 below those pre-pandemic levels. But we see unemployment now peaking at 5.8% in the fourth quarter of this year. That's substantially better than where we were when we spoke last time, when the fears were that UK unemployment could surge to above 9%. So significant change in expectations there that very much filters through to our view in terms of the UK economy. So we think UK growth will be very strong this year, highest since the post-war at 5.9%. And also worth recognising good momentum as you go through 2022 as well, where we're penciling growth of 4.2%. Then we start to see the UK economy, and I think economies around the world, returning to a more trend growth figure. In terms of the policy outlook for the UK, I think the prospects of negative interest rates have all but evaporated. Of course, that was one of the talking points that we had when we spoke last time. That certainly doesn't look anywhere near on the cards at the moment. It would take a huge deterioration, I think, in terms of UK's growth prospects for that to become a reality. We think the MPC will keep the status quo in place as the recovery plays out. Therefore, as I said before, we expect rates to remain at that historically low level of 0.1% through the course of 2020. The risk, if anything now, of course, is of an earlier rate hike. There are upside risks if a significantly stronger recovery materializes and inflation is projected to be sustainably above that 2% mark. What could drive that? Well, higher than expected consumption, consumers running down accumulated savings at a faster rate, faster recovery in terms of labour market, creating wage growth, but also businesses, I suppose, starting to exert some pricing power in response to the robust demand. But we should also appreciate, of course, the tax hikes that are announced in the budget already mitigate some of the risk of that overheating. So I think when we look at the UK economy, robust rebound, absolutely. The consumer very much driving that, particularly in the second half of the year. Policy remaining on hold and continuing to be incredibly supportive. And that's good news, say, for the UK's growth profile. So my time is nearly up, I think. So that's our view in terms of the outlook for the UK economy and perhaps more broadly around the global economy and threat of inflation. So with that, let me hand back to Emma.
Thank you so much, Hank, for those insights. Now, before I invite our next panelist, I'd like to remind our viewers to keep those questions and comments coming in. We'll pick these up in our discussion shortly. I'll now ask Arif Ahmad to share his insights. As a brief introduction, Arif is an experienced partner at PwC based in Leeds and has recently taken on the role as chair of the PwC UK-India Business Group. Arif joined PwC in 1996 and became a partner in 2009. In addition to his India role, he is the risk line of service market leader for private business and private equity nationally, and he also leads PwC's private business practice across the north of England. Arif, over to you.
Thanks, Emma, and I hope everyone watching today is safe and well. So look, lots of commentary about the impact of COVID-19 on economies around the world, and Henk just did a great summary of Barclays' view. PwC view of life for the UK, short to medium term, is definitely pretty positive here. We saw a sharp decline in GDP in 2020, particularly that first half of the year as the COVID restrictions hit for the first time. But we saw a really strong rebound in the second half of the year. That stalled a bit in Q1 of 2021 with new lockdown measures, and GDP was down by 1.5%. What we did see in March, as things started opening back up again and some of that demand coming back, things were up compared to 2020. And that's definitely likely to have continued through April and May with a further easing of lockdown restrictions. And only, in this last few weeks, as non-essential retailers open, and this week indoor hospitality settings reopen, some real signs of pent-up demand there, and people just fatigued with being at home and not having anything to do. So that's definitely fueling a surge in demand. You'll no doubt have seen the Bank of England's forecast recently that 2021 looks like being the fastest level of growth for the UK economy since World War II. But worth remembering that even with that growth, overall GDP at the end of this year is still likely to close at below pre-pandemic levels, so still a bit to go in terms of the recovery. The vaccine rollout definitely been a silver bullet for the UK. That's provided a big boost to the positive sentiment around the UK economy, and it's certainly enabled us to go faster on opening up than many other countries. Obviously, new variants always remain a concern, but that core underlying level of vaccination will certainly help us in that regard. And then government measures, things like the extension of furlough until the autumn, that's given companies a bit more breathing space and a bit of a cushion. So even if there are some short-term volatility in demand, they can probably ride that out by still utilising the furlough scheme. Now, if I'd been speaking at this webinar even probably 2-3 weeks ago, I wouldn't have even mentioned inflation, and we heard Henk's views around inflation. Just this morning, figures out showing that inflation increased to 1.5%. But importantly, actually, if you strip out the impact of the temporary VAT cut for hospitality, that figure would have been almost double that. Now, too early to say whether this is a trend, but there are certainly signs in certain sectors of inflationary pressures building in the economy, so it's a one to watch there. Picking up on then a few other macro predictions for 2021 from a PwC perspective around the UK. The population in London expected to decline for the first time in the 21st century this year. This last year fundamentally changed people's views on how we work and where we need to live. And all that will certainly fuel the government's levelling up agenda and provide a boost to the regional economies. On a similar theme, net migration with the EU likely to be negative in 2021. And that reflects a couple of things. So the end of the Brexit transition period certainly playing a part there, but also COVID-19 has disproportionately affected sectors that rely more heavily on migrant labour. So we're seeing a lot of commentary at the moment from the government and observers around potentially an Australian-style points immigration system. And that's all around encouraging skilled labour to be able to come to the UK, both from within the EU, but also more widely. Unemployment obviously has been going up over the last year and probably will go up even more as those furlough measures come to an end later this year. The furlough and the government loan schemes have certainly kept the level of overall distress in the economy relatively low so far. But as things open up, perversely, there's a greater requirement on companies to fund working capital and fund costs that are coming back in. So we are likely to see more distress coming into the economy later this year as some of those government support measures taper off. Gender and ethnicity pay gaps likely to increase, reversing some of the progress that we've seen in this area over the last few years. The economic impact of the pandemic certainly been felt disproportionately by women and people from a BAME background. And again, that plays to sectors where they are typically active. And then finally, just in terms of the macro trends, a real focus on build back better. That's a term we're hearing a lot of. And COP26 will again sort of build momentum around this area. So what else are we expecting? Well, the government doesn't normally do this, but they've taken the unusual step of issuing a growth paper and setting out where they see that growth coming from for the UK economy. And that's got three key pillars. Infrastructure being the first, around stimulating short-term economic activity, driving long-term productivity improvement through what's going to be a record investment in things like broadband, roads, rail, cities. And that spending plan worth £100 billion next year alone. So really big infrastructure investment. We're already starting to see some supply chain issues as a result of that in the wider construction sector. And again, that's driving some of the inflationary pressures there as well. As part of this, though, let's not forget about net zero, really important part of the agenda, and £12 billion of funding for projects through a 10-point plan for a green industrial revolution. That's just the start. We're going to see a lot more of that and support for investment in this area coming through the new UK Infrastructure Bank. The second key area of growth then is around skills. I already talked about the potential Australian points immigration system. And that's also about supporting productivity growth through really high quality skills and training, and trying to move that post-16 age group technical education system and aligning it better with where employer demand lies. A lot of focus on apprenticeships over this last 2 or 3 years with the apprenticeship levy, and we'll definitely see more of that coming. And then the final area is innovation. So lots of support and incentives to develop creative ideas and technologies, and that's going to help shape the UK's future high growth sustainable economy. Part of that, the £375 million future fund, and then the recent budget announcements to stimulate investment. Just a quick comment then around the UK-India corridor, recognising this is a UK-India Business Council event. So the recent publication of the integrated review by the government into security, defence, development and foreign policy, and that's got a significant slant towards resetting the UK's international priorities with more of an Indo-Pacific tilt as we've come out of the EU. And aligned with that formation of the D10, so that's the 10 leading democracies of the G7, plus India, South Korea and Australia. What's all this about? Well, undoubtedly, one of the key drivers here is creating more of a democratic alignment of interest to act as a counterweight to China. And India, given its geography, clearly has a very important role to play there. Also clear that even with Boris Johnson having to twice cancel planned trips to India as a result of COVID, the moves towards an enhanced trade partnership between the two countries as a precursor to a full trade agreement, definitely showing the importance of the relationship between UK and India. And again, that political dynamic with China is part of the thinking here. So to wrap up, lots of reasons I think to be positive about the UK economy, some real trends that we're seeing around that sort of growth plan, the infrastructure, skills and innovation piece. No doubt there'll still be some bumps along the road in the coming months, but the dynamics remain good and we should see a prolonged period of that positive sentiment towards the UK economy. So with that, back to you, Emma.
Thanks so much, Era. Some very interesting points raised there for sure. Last but not least, I'd now like to invite our final speaker, Fuchsia Bose, to share her thoughts. Fuchsia is a counsel at Freshfields Bruckhouse Derringer, based in London, and she co-heads the firm's Global India Focus Group. Over the course of her career spanning London, New York, and India, Fuchsia has acted for many of the world's leading corporations, private equity firms, and investment banks. Her practice covers a broad range of corporate transactions, including public and private mergers and acquisitions, reorganizations, and joint ventures in jurisdictions across the world. She has extensive experience involving emerging markets such as India. Fuchsia, thank you so much for joining us. Look forward to your insights. Thank you.
Thank you very much, Emma. And thank you, Hank and Arif as well. Excellent summaries, and it's always a tough act to follow two great speakers. I'm going to spend about 10 minutes talking about M&A over the last 12 months. Obviously, we were and continue to be, in some respects, in really sort of unprecedented times. Hank and Arif have talked about some of the economic impact of that and what we see in terms of macroeconomic trends. Emma, if we could move to the next slide. These are the sort of main areas I was going to cover. I was going to start off with just giving a little bit of a flavour for what we saw in terms of global M&A over the last 12 months. And then what we've seen in the first quarter of this year as well. it won't come as a surprise to anyone that actually global M&A was pretty shaken up in 2020. Deal making fell sharply year on year end for the first half of 2020. And I think the M&A trend for entire 2020 was about 9% down. But the second half of 2020 was phenomenal increase in intensity in M&A. So in some ways that 9% doesn't truly reflect the year. It was really a year of two halves, two completely different halves. I'll give you some stats just for context. There was a 786 billion worth of transactions announced between July and September alone last year. There was also a resurgence of sort of mega deals, big ticket M&A deals announced in Q3 and Q4 of last year. The stat that really sort of stuck out for me was that there was a 79% uptick in value of deals between the first half of last year and the second half of last year. I think that's the biggest half-year jump on record, and there was more than $1 trillion in deals that were announced in Q3. So that's just really to sort of set the scene for the year that we saw last year. I think we all expected M&A to pick up once the immediate sort of crisis sort of stabilized a little bit. That's always been the trend historically after the financial crisis. That we saw that happening. That's always happened historically, but I think we were surprised at the intensity of the activity that we saw in Q3 and Q4, especially when you contrast, you put that into context with what Hank was saying about the 3% contraction in global economy. What we've seen so far is that this bull run that began in Q3 of 2020 shows no real signs of slowing down. M&A between January and March of this year broke the $1 trillion barrier for the third consecutive quarter. PE activity levels remain very, very robust. And Q1 of this year has been one of the most sort of active quarters since 2001. The UK M&A market is a similar story. M&A initially stalled last year, and I'd say that's March, April, May of last year when the UK was going into lockdown. There was lots of fear, uncertainty. The pandemic was still new, the lockdown was new, and so there was a lot of sort of anxiety, and M&A really just came to a standstill. We saw that reflected in deal activity that we were seeing, and I think the figures confirm that and corroborate that. But similar to the global market trend, deals recovered pretty strongly, and Q3 and Q4 was massively busy. The value of the UK deals for 2020 was around $428 million. $428 billion rather, and that was 13% of the global total. So just to put context, that was a pretty significant number, especially when you look at how the first half of last year was actually fairly quiet. The UK deal market remains very active in 2021. M&A deal value was up 72% in the first quarter of 2021 compared to the last quarter of 2020. So what is really driving M&A in 2021? There are a number of different factors. I will do a quick canter through a couple of them. Volatility and uncertainty really, I think, are the enemy of M&A. Once there is greater certainty in the macro environment, if things continue to stabilize and the trajectory of the return to normal continues, I would expect M&A activity to continue to increase. The big one, Hank and Arif both mentioned, vaccine rollouts. I think they're happening at a pace better than expected, at least in the UK and the US. And that means there is a roadmap to recovery that's visible. That creates greater consumer confidence, and again, the return to normalcy beckons, and that helps build the confidence. One of the other factors for last year, in addition to the pandemic, was of course Brexit. I think the uncertainty of a Brexit sort of been hanging over the UK for the last few years. That is now done. There's a EU-UK deal done, and so that level of uncertainty now goes away. The US presidential election, there was some uncertainty around that last year as well. That's also done. Interest rates remain low, keeping the cost of borrowing down, and so really there are a number of different factors for a perfect storm for continued robust M&A. The other thing I should mention is, of course, that people have adapted to doing M&A virtually. There was a little bit of a scramble initially, having to do negotiations all online, having to do diligences online. But I think investors, companies, intermediaries have all worked out and have got very good at it using technology. Site visits are happening remotely, diligence is happening remotely, and so deals are now being done remotely, and that as a factor is not that relevant anymore. I think initially people wondered whether the not being able to travel is going to sort of impact cross-border M&A massively. I think the answer to that is we've been using technology now, and technology has been far more successful than I think people anticipated it being in terms of doing deals virtually. In terms of the sectors that we've seen sort of activity over the last year, I think the clear leader in the pack is TMT. Tech-driven M&A sort of led the charge in 2020, and that's really contributed the largest to global activity levels. Tech remains a priority for corporate and private equity buyers. I think COVID has really has highlighted the importance of digital assets and tech. And so it's not a surprise that tech and software deals are being keenly contested and sort of attracting higher premiums. I think tech is going to weave its way into a number of different areas. I think healthcare is going to see a lot of tech in it. Supply chains are going to see a lot of tech coming through. I think the pandemic has really tested supply chains across the world for a number of reasons, geopolitical reasons, but also tech, and I think a number of organizations and companies are really looking at supply chains to see how they can make them more resilient, and some of that will be through using tech. So I think tech is very much here to stay, and we will be seeing that in years to come. The other area that we've seen activity and where we think there's going to continue to be activity is actually transport and infrastructure. Arif mentioned that as well, and I agree. I think we will see infrastructure as a very core pillar going forward. There have been some sort of mega deals in the transport and automotive sector, but I think globally we will continue to see infrastructure. Certainly in the UK, the government has sort of mentioned, as Arif said, that they are keen to invest in infrastructure in the UK. Similarly, in India, the government is keen to invest in infrastructure. So I think those are going to be sort of core pillars of growth. The third one, I think, is energy. Energy, mining, utilities. I think that has been a space where we have seen activity and where I think activity levels will increase. As we see the shift globally from traditional energy to more renewable energy, and as that strategy continues across the world, I expect there to be sort of increased activity levels across that space. Healthcare and life sciences, of course, goes without saying, they have been very active and will continue to remain robust, I think. I'll just spend a couple of minutes on SPACs, because I think no M&A session these days is complete without talking about SPACs. So I will, of course, mention that. SPACs have really, as most people know, been the hottest story in town for most of last year and for part of Q1 this year. They've been one of the principal drivers of global deal making. US SPACs have now been looking at overseas targets as well. In fact, I think in the past 3 months, there have been more sort of overseas targets that US SPACs have targeted more than in the past 20 years combined. And so I think now the SPAC story, and particularly the de-SPAC story, is becoming a real sort of global phenomenon. SPAC listings have so far largely been a US dominated piece. However, the European market is now competing with the US as a venue for SPAC flotations, not in the same level as you're seeing in the US, but Amsterdam have had a few SPACs which have listed there, and rumored to have a few more. Frankfurt is looking to develop a more competitive SPAC structure for listings, as is the UK, of course. The UK government has commissioned an independent review by Lord Hill to gather evidence and to make recommendations to really increase the competitiveness of London as a listing venue of choice post-Brexit. The report has made a series of recommendations to reform the UK listing regime to really make it more fit for purpose, and the new rules could really see a number of sort of changes which would really be fairly transformative, and could encourage sort of SPAC investments as well as other IPOs on the London market. The FCA has welcomed the report and has said it will carefully consider some of the recommendations. It intends to act quickly, it has said, with the aim of publishing a consultation paper by the end of the summer and potentially new rules by the end of this year. So we could potentially be looking at, in the next 12 months, a period of real sort of transformative change in the UK's listing regime. The question, I get asked frequently, is the SPAC bubble going to burst, or when is it going to burst? And that's an interesting one. I think we will potentially see a little bit of slowing down. The SEC has recently changed its messaging somewhat on SPAC deals, and it's anticipated that they will change their classification of how they look at SPAC warrants from equity to being a liability on the balance sheet, which could really have ramifications on the SPAC IPO listings in the pipeline. However, we mustn't forget that there are a number of SPACs in existence which have a 2-year life cycle. So I think it's pretty safe to say that that's not going to go away, and there will continue to be these SPAC deals. But it will be interesting to see if that SPAC boom sort of reduces in intensity. Finally, just very quickly, in terms of my predictions for the rest of 2020, rest of 2021, the pandemic really continues to be the biggest threat to businesses, and the effects of that are really going to continue right through 2022. A number of sectors and businesses have been really hit hard and under tremendous strain. Retail obviously is the big one, and the longer the effects continue, the longer we can have lockdowns or partial lockdowns, the harder it will be for them. In terms of sort of more positive news, I think there is certainly now precedent and experience of working through lockdowns and working through the pandemic, and so therefore there is a greater ability to withstand that, and there is more resilience. As a result of the pandemic, there is an enormous sort of demand for acquisitions and a sort of significant war chest that's been built up in some corporates and certainly in private equity. There is probably going to be a run of sort of preemptive divestitures, the so-called fix it first. So, you do the divestitures you need to do early on, so that when you go to the competition authorities, the scrutiny will not be quite the way it might have been otherwise. I think competition authorities will be looking very closely at sort of concentrations of power to protect consumers from what's already been a pretty battered situation because of the pandemic. I saw a study recently, I think it was by E&Y, which basically said they thought that 57% of UK executives have said that their companies are going to actively pursue M&A in the next 12 months, and that they anticipated that the key areas of investment destinations were going to be Germany, the US, the UK, France, and India, which I thought was very interesting. So in summary, I think the continued uptake in UK M&A, I think, is going to continue. It's going to be private equity who do have cash, as well as some corporates that have survived the pandemic. And once they come out on the other side, I suspect they will want to try and consolidate their position in the post-pandemic world. And therefore, I think the momentum that we've seen in M&A over the second half of last year and the first quarter of this year, I think that's going to continue very much for the rest of this year. And with that, Emma, over to you.
Thank you so much, Piyusha, for those remarks. And thank you again to Hank and Era. I would now like to hand over to UKIBC Director Chris Hayes, who will be moderating our Q&A session. If you have any questions for our panelists, please do drop these into your control panel and we'll pick these up. Thank you so much. Chris, over to you.
Thanks very much, Emma, and thanks to everybody for what was a fantastic discussion indeed. Special thank you to Emma, who got up this morning at 3:30. She's based in Atlanta at the moment, so a very early start for her. I can't believe it's been a year since we last held this session. I was thinking before we started, a year ago, we were talking about pubs and restaurants just about opening up, the government's furlough scheme coming to an end, and the worrying new worrying new variants on the trend. So it's very strange how this come back around again. Lots of questions obviously come in from a lot of people, but just to start off, and just a reminder, please keep those questions coming in. Just to start off, Henk, I wanted to talk about the currency markets, which have obviously been absolutely all over the place in the last year. I mean, obviously we deal with India, and INR was 105, then down to 90, back to 103. US, pound, dollars being all over the place as well. What sort of impact are you seeing that having on the economy, and how are businesses trying to sort of hedge for those big shifts in currencies?
Yeah, you're absolutely right. We have seen some significant movements, certainly in foreign exchange markets, and it's one of the big questions that we continue to be asked by our clients is what's going to happen in terms of the major currencies and what's the outlook for them. Our broad view in terms of foreign exchange markets is the dollar will strengthen. We think the euro will weaken and sterling will continue to recover, I think, during the course of this year. We've spoken a little bit about the UK economy already. Sterling, we think, will do well. From a valuation perspective, sterling still looks relatively cheap. Of course, there was a big discount during the course of the negotiations after the Brexit vote, and that's starting to dissipate a little bit, but still, from a historic basis, looks relatively cheap. We've been talking about those Brexit concerns have been diminishing. Fiscal response has been more aggressive in the UK as anticipated. Growth profile is getting stronger. Of course, the UK's prospects are, of course, anchored towards Europe, where the recovery has been less pronounced, and the slow vaccination program continues to pose a problem there. But the stronger vaccination story in the UK, faster reopening, less long-term economic scarring, I think poses a positive backdrop for sterling during the course of this year. And we've spoken a little bit about interest rates and fears of negative interest rates disappearing as well. The euro, a very different picture, I think. Slower recovery there. So UK growth, we got at 5.9%. European growth, we're at 4.1% this year. Got a lackluster vaccination program. Got long-term underlying issues, structural issues there that's addressed a slower trend growth, even as we start to emerge from the pandemic. In Europe, we've also got political risks as well. You've got elections taking place in Germany and France during the course of this year. And the European Central Bank likely to remain incredibly accommodative for a prolonged period of time. So that weaker growth profile, slow disbursements from the European Recovery Fund, that slow path to normalization, we think will very much weigh on the euro during the course of this year. The dollar, we still remain positive. Dollar's been under a little bit of pressure over the course of the past weeks, but from the dollar, we think the flexible structure of the US economy, its technology leadership, robust recovery momentum, all point to continued US economic outperformance this year. We've got growth in the US at 7.1%. Eventually, we think interest rate differentials will come into play. And actually, you could argue, even if our base case of this positive recovery doesn't play out for whatever reason, there are a number of risks that we've spoken about today, medical risks, financial risks out there that could stall the recovery, then actually the dollar would still perform well in a risk-off environment as well. So let me finish off by giving you our headline figures to the end of the year. So we've got euro dollar at 114, we've got euro sterling at 0.81, and the pound against dollar we think will hold somewhere around that 140 level.
Thanks, Hank. Good, and great to have those forecasts as well. That'll hopefully give businesses a bit more certainty in terms of that aspect. Arif, just a question for you. Obviously, last week you and I were on the UKIBC roundtable with Minister Jayawardena talking about the enhanced trade partnership in India. And interestingly, he also mentioned that pan-Asian tilt that we're now seeing. Are you guys seeing that from UK businesses? Are you seeing more businesses now looking further afield in terms of exports and in terms of investments? Obviously, historically, it has always been Ireland or France to start with. But are you seeing more, obviously, as these free trade deals with Japan, the proposed ones with India come on the cards, are you seeing people now sort of looking further afield?
Yeah, look, I think it's early days, but certainly seeing some of that. So, you know, our economic landscape has been dominated by the EU for so long. You know, that has been the default for many businesses in terms of, you know, if you're taking those first steps to exporting, let's go with an environment that we're familiar with, an environment that was you know, part of that partnership. Over the last few years since that EU referendum back in 2016, you know, preparatory steps for companies to start looking further afield, and certainly, you know, the desire of the government to open up some of these enhanced trade partnerships, trade agreements with countries further afield will fuel that for companies to think about. And particularly, you know, when you think about the likes of India, which has such a large population, such a burgeoning middle class, and such a demand for Western products, you know, that opportunity to export is certainly there, and we are seeing, as I say, early signs of companies starting to look further afield, starting to think more broadly about where those export markets might lie. Interesting as part of that then to see the budget announcement around Freeports, which obviously has, you know, an inbound element, but certainly has an export element as well, with potentially incentives and, you know, lack of duties and things on exports that will be available. So it'll be really interesting to see how that plays out over the next sort of year or two with those Freeport areas that have been designated by the government.
Fantastic. Thanks very much, Arif. And yeah, I think the Freeports is going to be a really interesting concept. Obviously works in a number of other major countries. So yeah, looking forward to seeing how that policy comes through. Piyush, just sort of moving over, obviously India last year was the second largest FDI investor in the UK, and we saw a number of announcements, you know, over the last year. You know, most recently Mahindra have announced that they're going to be bringing their technical design centre to the West Midlands. We've obviously seen TVS Motors with acquisition of Norton, and of course the UK government and Bharti, the joint venture into OneWeb, which obviously was bought into as well by the French last week. Is that something that you see will continue over the year, that Indian investors are seeing the UK as a natural place to invest? And what can the UK government do to support those investors?
Thank you, Chris. Yes, I agree with that. Actually, I think we are. I think many of us have been around long enough to hear. We've been hearing about this wave of outbound work from India that's going to be happening, and it's never really come to fruition. But I do think we are beginning to see that. I think it is still early days, but there certainly is interest, and I think the government is setting a narrative that is helpful. The British government, I think, is very keen to develop this partnership. I think this is probably the most keen I've seen a government for a while in terms of trying to set up a partnership, free trade agreement. Because I remember looking at this a couple of years ago in terms of free trade partnerships between Britain and India, and actually the message I was getting was not going to happen for ages. And actually right now the message I'm getting is no, it's actually very positive noises. So I think that itself shows a relative shift in attitude landscape. I mean, of course, there was the Serum Institute announcement as well of investment in the UK. So I think there have been a number of big Indian corporates who are looking at the UK. And I think that the question for me really is, if there are certainly Indian corporates, big businesses who are looking to go outside India, where do they choose to go? And that's going to be where I think the UK can really focus in on and say, there are a number of reasons why you should come to the UK. There is a shared history, there is an environment you're used to. We can make it really advantageous for you to come to the UK, because India also has strong links with Germany. It also has strong links with a number of other countries, with the US as well. And so I think it's going to be very important to try and capitalize on the India-UK history and relationship to try and focus on that.
Yeah, cheers. Thanks, Baisha. Linked to that with a question that's come in from Ray and talking about, you picked up on this piece in your presentation about a lot of this activity happening in the sort of the tech sector, a lot of M&A activity. So the question is, how do governments respond to ensure there is still fair and open competition in this landscape where you have these large tech firms making huge acquisitions, and many businesses now, their dream is to be bought out by Facebook or Google. How do you balance that?
I think that's a difficult one. I think that's something governments across the world are grappling with. I'm not sure there are any easy answers on that one. I think that's something, I mean, really, if you look at the US, if you look at what's happening in the EU, that is an ongoing tension. And I think it will remain an ongoing tension. There will have to be interests that have to be balanced and interests that have to be safeguarded. But yet tech is very much here to stay. And so we have to figure out, and we have to navigate that very delicate dance and work out how to balance both of those. But I think there are no easy answers, but certainly that is a very key theme at the moment.
Cheers, thanks, Peter. And then Henk, you talked a bit about inflation in your side, and one of the questions that's come in from Hiran is around that sort of debt levels. Obviously, people in the UK are used to very small mortgages. Obviously, people have maybe taken on large houses, particularly obviously in London. And businesses are obviously used to having access to cheap finance. You're suggesting that obviously over this year, inflation will potentially be 1% more. What impact do you think that will have in terms of businesses being able to obviously pay back the various loans that they've got, and obviously on mortgage repayments?
Yeah, it's quite an interesting concept, this threat of inflation. As you say, it certainly built some momentum, certainly in sentiment over the course of the past few weeks. We saw inflation, say, printing higher today. We actually think that it's still going to be transitory, the inflation, as we've been talking about. For the UK, we think inflation will peak at 2.3% in the fourth quarter of this year, then start to ease back as we look through 2022. If you look at our average inflation expectations, we've got CPI averaging 1.7% this year and around 1.9% during the course of 2022. So significantly still remain below the mandated levels that the Bank of England is aiming for. And I think we've got to move beyond the low base effects that we're seeing in terms of inflation currently, and understand the central bank's focus on the medium term. And that's what's going to be important in terms of policy. And as I mentioned during the course of my comments, so I think the MPC will remain incredibly accommodative for a prolonged period of time. And that certainly suggests to us that rates on hold, not only this year, but next year. If you look at consensus figures, they actually don't have a hiking interest rates until probably the second half of 2023. So for many businesses, they can be relatively relaxed against that backdrop of accommodated policy support.
Cheers, thanks, Hank. That's reassuring to hear that. Arif, we've got a question come in around employment. We saw this week, employment levels now and vacancies at a similar level to last year. 650,000 jobs currently on the market. Many of the hospitality and leisure industry complaining they can't actually recruit people at the moment. We've obviously talked about the new points-based immigration system that's coming in. And obviously, you've got to factor in as well as 4.2 million people still on furlough. So what's your sort of thoughts about how this is all going to sort of come to a head really during this year?
Yeah, it's a really interesting debate, actually. I think most people, as I said earlier, would have expected a higher level of company distress than we've seen over the last year, given huge volatility in demand that we've seen and certainly in particular sectors. As those significant number of people who are still on furlough start coming back into the system, it adds to the cost pressures that companies are facing, and certainly those that are teetering on the edge might just find that a bridge too far, and that will undoubtedly lead to more distress in the economy in the coming months, which then fuels unemployment. What we are seeing though in certain sectors, and this plays back into that point I made earlier about EU migration being negative this year, or expected to be negative this year, is that in certain sectors, skills shortages are very much there, and the availability of appropriate labour is very much there. So we're going to see a bit of a two-paced economy around this, where unemployment will build in certain sectors. In other sectors, there'll be real shortages of people, and particularly sectors that experience a significant uptick in demand in the coming months. There'll be some real shortages there. So the flexibility and adaptability of people to move from one sector to another is going to be ever more important. And that goes back then to the government's sort of skills training agenda, trying to move people and have people be agile between different sectors, and have more sort of job-based training and apprenticeship-based training to fuel that sort of labour market. So it's going to be an interesting one to watch. I think, undoubtedly, as furlough comes to an end, unemployment will go up, but there will still be opportunities in other sectors for people to move across to.
Cheers, thanks, Harry. And one final question from me. So we're on this path now towards a free trade agreement with India. So each of you have got one ask of the UK government as part of this. Payusha, I guess you're going to be asking for the opening up of the international legal services in India. But what would your one ask be that you would like to see to help UK businesses benefit or maximise the benefit from the trade deal? So Arif, if we start with you.
I would say more certainty within the Indian tax system would certainly give more companies the confidence to be able to invest.
Fantastic. Payusha?
That was going to be my one as well, actually, because actually one of the big points that always comes up is tax, and so actually more certainty around the interpretation and enforcement of tax laws, and doing business in India generally in terms of all the smaller tax authorities and other licenses and regulatory authorities. I think progress has been made, but very much on my list.
Cheers, thanks. And Henk, finally over to you.
Well, I'll go along with those comments. Not really my area of expertise, but the reality is transparency and certainty is the key to building confidence. The greater levels you have in that, the greater opportunity there is for deals to be done. In reality, of course, with Brexit happening, the UK economy, with this newfound freedom away from Europe, should be looking to fast-growing parts of the world to take advantage of that. Let's hope we gain some of that momentum and authorities can work together in order to build that trust and to increase the transactional relationship.
Excellent. Thank you very much for this final point. Well, a huge thank you from me to Payusha, to Arif and to Henk. Really appreciate your time and thank you for answering those questions, and thanks for the fantastic presentation. Just a reminder to everybody, you can follow us on Twitter if you want to keep up with all of UK-India trade activities. It's at UKIBC. Follow us on LinkedIn, just search UK-India Business Council, or to receive our free newsletter, go to our website and register. A huge thank you for all the attendees from across the globe for listening to this fantastic webinar, which has obviously been over the last hour. We have other webinars available on our website if you want to watch them back. And finally from me, everyone, please stay safe, stay well, and we look forward to seeing you on the next UKIBC webinar. Thanks, everybody.